Goals-based planning. Goals-based planning is a client-centered wealth management framework that focuses on achieving specific life objectives rather than simply maximizing portfolio returns. The approach begins with identifying a client's personal, family, and financial aspirations and then developing strategies to support those goals. Unlike traditional investment management, which often emphasizes benchmark relative performance, goals-based planning measures success by the likelihood of achieving desired outcomes. Examples include funding retirement, supporting education expenses, purchasing property, transferring wealth, or meeting philanthropic objectives. Wealth managers must understand a client's priorities, values, risk tolerance, and time horizon to create a tailored plan. This process aligns investment decisions directly with the client's unique circumstances and long-term aspirations. A key feature of goals-based planning is the categorization and prioritization of goals. Goals are commonly classified according to importance, time horizon, and flexibility. Essential goals, such as maintaining lifestyle needs and retirement income, typically receive the highest priority because failure would significantly affect quality of life. Aspirational goals, including luxury purchases or legacy ambitions, may receive lower priority and greater investment risk capacity. By ranking objectives, wealth managers can allocate resources more effectively and determine which goals require greater protection and certainty. This structured approach helps clients understand trade-offs among competing objectives and supports more disciplined decision-making when financial resources are limited relative to desired outcomes. Risk assessment within goals-based planning differs from conventional portfolio theory because risk is defined in relation to goal achievement rather than solely through market volatility. Wealth managers evaluate the probability that a client may fail to achieve a stated objective and determine whether available assets are sufficient to meet future needs. This perspective encourages discussions about acceptable trade-offs between risk and certainty. Essential goals may require conservative strategies emphasizing capital preservation, while aspirational goals can support more aggressive allocations seeking higher expected returns. By linking risk directly to client objectives, advisors improve client understanding and foster stronger commitment to long-term investment plans during periods of market uncertainty. Asset allocation remains a critical component of goals-based planning, but portfolios are often organized according to individual goals rather than as a single aggregate portfolio. This approach, sometimes described as goal segmentation or mental accounting, assigns specific investments to particular objectives. Near-term goals may be supported by highly liquid and low-risk assets, while long-term goals can utilize growth-oriented investments. Such segmentation helps clients visualize progress toward objectives and improves communication regarding portfolio strategy. Wealth managers must balance behavioral preferences with sound investment principles, ensuring that each goal receives an appropriate allocation based on its time horizon, importance, and required probability of success within the overall wealth plan. Comprehensive wealth planning for private clients. Comprehensive wealth planning expands beyond investment management to address all aspects of a client's financial life. The process integrates human capital, financial capital, liabilities, taxes, insurance, retirement needs, estate planning, and family objectives into a unified framework. Wealth managers seek to understand not only the client's current financial position but also future changes in income, expenses, family circumstances, and wealth transfer objectives. This holistic perspective recognizes that financial decisions are interconnected and should not be evaluated independently. Effective comprehensive planning therefore coordinates multiple strategies to maximize long-term financial well-being while supporting both financial and non-financial goals throughout the client's lifetime. A fundamental concept in comprehensive planning is the distinction between human capital and financial capital. Human capital represents the present value of future earnings and economic opportunities, while financial capital consists of accumulated assets and investments. Younger clients often possess significant human capital but relatively limited financial assets, whereas older clients typically experience the opposite relationship. Wealth managers incorporate both forms of capital when developing recommendations regarding savings, investment strategy, insurance needs, and career decisions. Understanding the interaction between human and financial capital allows advisors to create more effective long-term plans, align risk exposure appropriately, and support the gradual transformation of future earning potential into sustainable financial wealth. Comprehensive wealth planning also emphasizes life cycle analysis and the management of evolving financial needs. Clients experience predictable transitions, including education funding, career development, family formation, retirement preparation, and wealth transfer. Each stage introduces unique opportunities and risks that require proactive planning. Wealth managers assess expected cash flows, future liabilities, healthcare costs, and retirement requirements to ensure adequate financial resources are available throughout life. Scenario analysis and stress testing are frequently used to evaluate how changing economic conditions, investment outcomes, or personal circumstances may affect financial goals. This forward-looking perspective improves resilience and supports informed decision-making under uncertainty while maintaining alignment with long-term objectives. Successful comprehensive wealth planning requires continuous monitoring, adaptation, and communication. Client circumstances, financial markets, tax regulations, and family priorities evolve over time, making periodic reviews essential. Wealth managers must reassess assumptions, update projections, and modify strategies when necessary to maintain alignment with changing objectives. The process is highly collaborative and depends on strong relationships built on trust, transparency, and education. Advisors often coordinate with attorneys, accountants, insurance specialists, and other professionals to address complex client needs comprehensively. Ultimately, comprehensive wealth planning serves as an ongoing framework for managing wealth, preserving financial security, facilitating informed decisions, and helping clients achieve meaningful personal and family outcomes across generations.